Hello everyone, welcome to this video presentation of Group C with this time material is current liabilities, provisions, and contingency. Enjoy the video guys!
Okay, now we're gonna talk about current liabilities. First of all, because liabilities involve future disbursement of assets or service, one of their most important features is the date on which they are payable. A company must satisfy currently maturing obligation in the ordinary course of business to continue operating. Liabilities with a more distant due date do not, as a rule, represent a claim on the company's current resources. Therefore, they are in slightly different category. This feature gives rise to the basic division of liability into current liabilities and non-current liabilities. And the current liability is reported into if one of two conditions exists. The first one is the liability is expected to be settled within its normal operating cycle, and the second one is the liability is expected to be settled within 12 months after the reporting date. And the operating cycle is the period of time elapsing between the acquisition of goods and services involved in the manufacturing process and the final cash realizations resulting from sales and subsequent collection. Now we're going to talk about typical current liabilities. The first one is account payable, is a balance owed to the others for goods, supplies, or services purchased on upon account. The term of the sales is 2/10 net 30 or 1/10 EOM. Usually state this period of extended credit, commonly 30 to 60 days. And the second one is notes payable, is a written promise to pay a certain sum of money on a specified future date. They may arise from purchases, financing, or other transaction. Companies classify notes as short-term or long-term. The third one is current maturities of long-term debt. As a part of its current liabilities, the portion of bonds, mortgage notes, and other long-term indebtedness that matures within the next fiscal years, and it categorizes this amount as a current maturities long-term debt, and exclude currently maturing long-term debt from current liabilities if they are to be 1. refinanced or retired from the process of a new long-term debt issue, and the second is converted into ordinary shares. Fourth one is short-term obligation expected to be refinanced. Is a short-term obligation. Short-term obligation are debt scheduled to mature within 1 year after the date of a company's statement of financial position or within its normal operating cycle. Some short-term obligations are expected to be refinanced on a long-term basis. This short-term obligation will not require the use of working capital during the next year. And the fifth one is dividends payable. Is an amount owed by a company to its shareholder as a result of the board of directors' authorization. At the date of declaration, the company assumed a liability that places the shareholders in the position of creditors in the amount of dividends declared. Because companies always pay cash dividends with 1 year of declaration, they classify them as current liabilities. Next one is customer advance and deposits. Is a current liabilities may include returnable cash deposits received from customers and employees. Companies might receive deposits from customers to guarantee performance of a contract or service, or as guarantees to cover payments of expected future obligation. And the seventh is unearned revenue. First of all, how do these companies account for unearned revenue that they receive before providing goods or performance service? And first The answer is two. The first one is when a company receives an advance payment, it debits cash and credits a current liability account identifying the source of the unearned revenue. The second one is when a company recognizes revenue, it debits the unearned revenue account and credits a revenue account. And eighth one is sales and value added taxes payable. Most countries have a consumption tax. Consumption tax are generally either a sales tax or value added tax. The purpose of these taxes is to generate revenue for the government similar to the company or personal income tax. These two taxes accomplish the same objective. It's to tax the final consumer of the good or service. And the ninth one is income taxes payable. It's most income tax varies in proportion to the amount of annual income. Using the best information and advice available, a business must prepare an incoming tax return and compute the income taxes payable resulting from the operation of the current period. And the last one is employee-related liabilities. Companies also report as a current liability amounts owed to employees for salary or wages at the end of an accounting period. In addition, they often also report as current liabilities the following items related to employee compensation, like the first one is payroll deduction, compensating absence, and bonuses.
A provision is a liability of uncertain timing or amount, sometimes referred to as an estimated liability. Provisions are very common and may be reported depending on the date of expected payment. The difference between a provision and other liabilities is that a provision has greater uncertainty about the timing or amount of the future expenditure required to settle the obligation. Companies accrue an expense and related liability for a provision only if the following three conditions are met. First, a company has a present obligation as a result of a past event. Second, it is probable that an outflow of benefit will be required to settle the obligation. And the third one is a reliable estimate can be made of the amount of the obligation. If these three conditions are not met, no provision is recognized. Here are the three examples of provision. There are warranty, lawsuit, and refunds. Next is the common types of provision. Here are some provision recognition in financial statement. First is lawsuit, second warranties, third consideration payable, fourth environmental, five onerous contract, six is restructuring. And next is litigation provision. Companies must consider the following factor among others in determining whether to record a liability with respect to pending or threatened litigation and actual or possible claims and assessment. First, the time period in which the underlying cause of action occurred. The second one is the probability of an unfavorable outcome. Third one is the ability to make a reasonable estimate of the amount of loss. And to report a loss and a liability in the financial statement, the cause for litigation must have occurred on or before the date of the financial statement. And to evaluate the probability of an unfavorable outcome, a company considers the following: the nature of the litigation, the progress of the case, the opinion of legal counsel, its own and others' experience in similar cases, and any management response to the lawsuit. With respect to unfiled suits and unasserted claims and assessment, a company must determine first the degree of probability that a suit may be filed or a claim or assessment may be asserted, and the second one is the probability of an unfavorable outcome. Next is warranties, provision and consideration payable. A warranty or product guarantee is a promise made by a seller to a buyer to make good on a deficiency of quantity, quality, or performance in a product. Companies often provide one of two types of warranties to customer. First is warranty that products meets agreed upon specification in the contract at the time the product is sold. This type of warranty is included in the sales price of a company's product and is often referred to as an assurance type warranty. The second one is warranty that provides an additional service beyond the assurance type warranty. This warranty is not included in the sales price of the product and is referred to as a service type warranty. As a result, it is recorded as a separate performance obligation. For the example, you can see on the slide.
So I will explain about the common type of provision. I will explain it start from environmental provision. So it's estimated to clean up existing toxic waste sites are substantial. In addition, costs estimated of cleaning up or air and preventing future deterioration of the environment run even higher. So in many industries, the construction and operating of long-lived assets involve obligation for the retirement of these assets. So when a mining company opens up a strip mine, it may also commit to restore the land once it completes mining. Similarly, when an oil company erects an offshore drilling platform, it may be legally obligated to dismantle and remove the platform at the end of its useful life. So, for accounting recognition of environmental liabilities, as with other provisions, a company must recognize an environmental liability when it has an existing legal obligation associated with the retirement of long-lived assets and when it can reasonably estimate the amount of the liability. Now, for the example of existing legal obligations that require recognition of liability include but are not limited to: first, decommissioning nuclear facilities; second, dismantling, restoring, and reclamation of oil and gas properties; third is a certain closure, reclamation, and removal costs of mining facilities; fourth is a closure and post-closure cost of landfills. And how to measure? So a company initially measures an environmental liability at the best estimate of its future costs. The estimate should reflect the amount of a company will pay in an active market to settle its obligation. Essentially, it should be a fair value. While active markets do not exist for many environmental liabilities, companies should estimate fair value based on the best information available, such as information could include market prices of similar liabilities if available. Alternatively, companies may use present value techniques to estimate fair value. And how to recognize and to allocation this? So to record an environmental liability in the financial statement, a company includes the cost associated with the environmental liability in the carrying amount of the related long-lived asset and record liability for the same amount. It records environmental costs as a part of the related asset because these costs are tied to operating the asset and are necessary to prepare the asset for its intended use. Therefore, the specific assets such as mine, drilling platform, nuclear power plant should be increased because the future economic benefits come from the use of this productive asset. Companies should not record the capitalized environmental cost in separate account because there is no future economic benefit that can be associated with the cost alone. So I already gave the example. So this is the accounting for this type of environmental liabilities. Assume that when on January 1, 2022, Wildcat Oil Company erected an oil platform in the Gulf of Mexico. Wildcat is legally required to dismantle and remove the platform at the end of its useful life. Estimated to be the 5 years, Wildcat estimated that dismantling and removal will cost $1,000. Based on a 10% discount rate, the fair value of the environmental liability is estimated to $620. Walcott record this liability as follows. So in the January 1st, 2022, the drilling platform is in the debit side with the amount of $620,000 and the environmental liability in the credit side with the same amount. So during the life of the asset, Walcott allocated the asset cost to expense using the straight line method. Walcott makes the following entries to record this expense. So in the December 31 for 2022, 2023, 2024, 2025, 2026, in the 5 year, they record the depreciation expense, which is the $620 is divided by 5, which is $124 in the debit side, and then in the credit side is accumulated depreciation plan asset with the same amount. In addition, Walcott must accrue the interest for each period. Walcott record interest expense and related increase in the environmental liability on December 31, 2022 as follows. So the interest expense is the $620 multiplied by 10%, which is $62,000, and then it's in the debit side. In the credit side is in the environmental liability with the same amount. On January 10, 2027, the Walcott contract with Reclaimer Inc. to dismantle the platform at a contract price $995,000. Walcott makes the following journal entry to record settlement of the liability. So environmental liability in the debit side with the amount of $1,000 or 1 million, and then in the credit side there a gain on settlement of environmental liability is 5,000, which is they gain something, they're not losing, they make a profit from this agreement, and then they give a cash to the reclaimers, which is a $995,000. So let's go to the next slide. So in this slide, I will explain about the two type of common type of provision. First, I will explain about the onerous contracts of provision. And sometimes company have what are referred to as a onerous contracts. So these contracts are ones in which the unavoidable cost of meeting the obligation exceed the economic benefits expected to be received. So for example of an onerous contract is a loss recognition on unfavorable non-cancelable purchase commitment related to inventory item. So for example, it's like assume that Smart Sports operates profitability in a factory that it has lease on which it pays monthly rentals. Smart decides to relocate its operation to another facility. However, the lease on the old facilities continue for the next 3 years. Unfortunately, Smart cannot cancel the lease, nor will it be able to sublet the factory to another party. So the expected cost to satisfy this onerous contract are €200,000. In this case, Smart make the following entry. In the debit side there is an account loss on lease contracts, which is to be amounted to €100,000. Well, on the credit side is in the lease contract liability, which is in the same amount. So the expected cost should reflect the least net cost of exiting from the contract, which is lower of the cost of fulfilling the contract or the compensation or penalty arising from failure to fulfill the contracts. And for the next provision type, I will explain about the restructuring provision. So the accounting for restructuring provision is controversial because once company make a decision to restructure part of their operation, they have the temptation to charge as many costs as possible to this provision. So the rationale, many believe analysts often dismiss this cost as not part of continuing operation and therefore somewhat irrelevant in assessing the overall performance of the company. On the other hand, companies are continually in state of flux, and what constitutes a restructuring is often difficult to assess. One thing is certain, companies should not be permitted to provide the future operational losses in the current periods when accounting for restructuring costs, nor should they be permitted to bury operating costs in restructuring cost classification. As a consequence, IFRS is very restrictive regarding when a restructuring provision can be recorded and what type of costs may be included in the restructuring provision. So this table that I show is a summary of a cost that may and may not be included in a restructuring provision. So for the cost that included is a direct and incremental. First, like a employee termination cost related directly to the restructuring. Second is contract termination costs such as lease termination, penalties. And third is onerous contract provision. And for the cost that's excluded is like investment in new system, lower utilization of facilities, cost of training or relocating staff, and etc. And for self-insurance, so as discussed earlier, liabilities are not recorded for general risks. So this is based in name. Self-insurance is not insurance, but it's a risk assumption. And a company that assumes its own risks put itself in the position of incurring expense or loss as they occur. So there is a little theoretical justification for the establishment of a liability based on hypothetical charge to insurance expense. This is as if accounting the condition for accrual stated in IFRS are not satisfied prior to the occurrence of the event. So exposure to risk of loss resulting from uninsured past injury to others, however, is an existing condition involving uncertainty about the amount and timing of losses that may develop. A company with a fleet of vehicles, for example, would have to accrue uninsured losses resulting from injury to others or damage the property others that took place prior to the date of the financial statement. However, it should not establish a liability for expected future injury to other damage to the property of the others, even if it can reasonably estimate the amount of losses. And lastly, for this slide, I will explain about the disclosure related to profession. So the disclosure related to profession are extensive. A company must provide a reconciliation of its beginning to ending balance for each major class of profession, identifying what caused the change during the periods. In addition, the profession must be described and the expected timing of any outflow disclosed. Also, disclosure about uncertainties related to expected outflow as well as expected reimbursement should be provided.
Okay, now let's talk about contingent liabilities. A contingent liabilities is defined into two ways. First, it can be a possible obligation from past event, but its existence will only be confirmed by in uncertain future event that the company does not fully control. Second, it can be a present obligation from past event that is not recognized. And why not recognized? Because either is it not probable to money or resource will need to be paid, or the amount cannot be reliable measured. There are three categories of contingent liability that are not recognized. First, a possible obligation that is not yet confirmed as present obligation. For example, a lawsuit. where the outcome is uncertain and the chance of loss is less than 50% but still more than remote. Second, a present obligation but payment is not probable. That means the probability of outflow is 50% or less. Third, a present obligation, but the amount cannot be reliably estimated. No reasonable estimate is possible even though the obligation exists. The key point is contingent liability are not recorded on the statement of financial position. They are only disclosed in the note unless the possibility of outflow is remote. Now look at the probability guidelines. If an outcome is virtually certain, meaning at least 90% probable, we report it as liability, which is a provision. If it's probable, meaning more likely than not, which is between 51 and 89%, we also report it as liability or provision. If it's possible not too probable, between 50 and 50, between 5 and 50%, we only disclose it, no accrual it made. If it remote less than 5%, no disclosure is required. Now, what must we disclose for contingent liability in the possible range? We need to give a brief description of the nature of the contingent liability. If possible, we provide an estimate of its financial effect. We also indicate any uncertainties about the amount or timing and the possibility of any reimbursement. And an example disclosed by Barwar Limited includes performance guarantees, repurchase commitment, risk share agreement, and tax audit. Now let's move to contingent asset. A contingent asset is a possible asset from past event. Its existence will be confirmed only by uncertain future event, not fully controlled by the company. The accounting treatment depends on the probability. If asset is virtual certain, at least 90% probable, we report it as an asset. Is it no longer contingent asset? If it's probable, more likely than not between 51 and 90%, we only disclose it. If it's only possible but not probable, between 5 and 50%, no disclosure is required. And if it remote less than 5%, no disclosure are needed. And here's are the key principle. Contingent assets are never recognized while they are still contingent. Once realization becomes virtual certain, the asset is recognized in the financial statement, and we must be careful with disclosure so that we do not give false hope of income. Example of contingent asset including possible receipt of money from gift, donation, or bonus. Also possible refund from the government in tax dispute and pending court case with a probable favorable outcome. For recognition, consider this example. Marcus Reality lease property to Marks and Spencer (M&S), and M&S cancels the contract and must pay a penalty. At the time of cancellation, a receivable and income are recognized. Is it no longer a contingent asset? Now let's compare between contingent liability, and contingent asset. For the definition, contingent liability definition is possible or present obligation not recorded, and contingent asset is possible asset not recognized. And recognition for contingent liability, if probable more than 50% and estimable, and it's become provision for contingent asset if virtual certain is more than 90%, it's become asset. For the disclosure, it's possible if possible 5 until 50% it's need disclose, and for contingent asset, more likely than not more than 50% is disclosed. And if remote or under 5%, both of them no need of disclosure. For example, contingent liability disclosure only a lawsuit with a 30% chance of loss disclose no accrual, and contingent asset a court case with a 70% chance to win disclose natural and estimated. Contingent asset become recognized. A lawsuit is settled after year end but confirmed as asset exists at year end, then recognize it. And now we see the two special issue. Reimbursement right under EI 37. If another party will reimburse you for part of a provision like insurance, you recognize a separate asset only when reimbursement is virtual certain. The asset cannot access the provision. On the income statement, you can show the expense net of the reimbursement and subsequent event. If an event after the reporting that eh, even after the reporting date confirmed as contingent asset exists at year end, recognized as a asset. If the event create a new asset that did not exist at end year, it is a non-adjusting event. You only disclose it. For example, it's hamburger example. Lawsuit pay 100,000 for a containment hamburger. 100 sold. Chance of contamination is 1 in a million. Is there a liability? No, it's not a liability. The past event did not create a probable outflow. Remote possibility, no provision, no disclosure.
So let's go to the presentation of current liabilities. So these current liabilities is usually reported at fully maturity value. Also, differences between the present value and the maturity value is will be considered as immaterials. There is like any examples here. It is Lumen Limited. They have current liabilities with the current asset, which is the asset will be inventory, trade receivable, other financial receivable, other non-financial asset, derivative financial instrument, investment securities, other bank deposit, cash, and bank balances. It's shown in 2018 and 2017. There is also current liabilities, which is like extra payables, other financial payables, other non-financial liabilities, derivative financial instruments, loans and borrowings, and also the last is tax payable, which is in show also in 2019 and 2017. Presentation, we will continue to analysis of the current liabilities. There is a current ratio, which is a current ratio is the total of the current asset divided with the total current liabilities. It's also called as a working capital ratio because working capital is the excess of current asset over current liabilities. So the current ratio we get it from current asset divided with current liabilities. But there's also other other method, which is asset test ratio, which is related to total current liabilities to cash, short-term investment, and receivables. So asset test ratio will be gathered from cash plus with short-term investment plus with net receivable, and then it will be divided with the current liabilities. We have illustrated a little bit here. We use information from International Limited like before. We knowing the calculation of the current asset and current liabilities. If we divided the 25 million with the 12 million, we will be having the current ratio in 2.2 times. And also for the asset test ratio, we need to calculate the cash, short-term investment, and net receivable, and we get in 16 million, and then divided with the current liabilities, which is in 12, and we get the asset test ratio in 1.27.
Thank you for watching the presentation video from our group. I hope this presentation will be useful for all of you, the viewer, and thank you. Bye bye.